Introducing the man, the one, the only, Josh Perkins. He started from nothing. He still is nothing, but he's making it, or at least trying to. That's something worth watching. Hello Youtubeverse, guess what? So today I got information about how you can pay your house off sooner rather than later. Instead of spending 30 years on your home, you can pay it off in 7 to 11 years. Just depends on what you want to do. At all in this video, it's not financial advice. It's just what I think makes sense in paying off a house. Now I'm using kind of close numbers to what my house is actually going for. So like you'll see principal, you'll see my interest plus escrow. And I'm going to explain all that stuff in my video to show you guys a very detailed explanation on how to pay the house off faster. So I bet you all want to stay tuned for that. Alright guys, here we are. So what I want to explain first, this is the interest. This is our variable, meaning this is the 7 years. This is our constant 30 years, what you generally pay. And what I'm going to explain is how to pay off your mortgage faster. So right here, we're going to explain super slow. Principal is your $400,000. This is what you're actually paying. So I'm going to explain what makes up your monthly mortgage payment. So this is $2,000 is your mortgage payment on a $400,000 house. Now, these numbers are not exact by far at any means. These numbers do not directly reflect. This is just a basis just to explain it in a very easy way. So, as I was saying, $600 is your principal. Principal is what goes directly to this. This is known as your principal. Your interest for this house, let's just say, is 3.75. The reason I use these numbers is because they're pretty close to what I use for my house, so it's easier to explain because I already have paperwork that gives me a general idea. So my interest rate is 3.75. So if you want to know how much you pay, you do 400,000 times your 3.75, and then you times that by 30. And you get 495,000 that you'll pay in that 30 years. That's a lot of money. I mean, you're paying almost double what you bought it for. Your interest obviously is what this is right here. This is what you're paying towards of that $1,000. Your escrow your escrow is pretty much your taxes and everything that goes into the state. I'll just put a T there for taxes too as well. So generally this comes out to $2,000, and that makes your mortgage payment. Now let's just say this is your income of $4,000 a month. That's your income. Now this right here is our line of credit, and what this line of credit is two things. You can get a home equity line of credit, or you can get a line of credit. So they're both essentially the same thing. They're low interest. Generally for me to qualify for this line of credit, and according to the Navy Federal person I talked to, you need to have at least a 700 credit score and no derogatory marks. So this is just stipulation. This home equity line of credit is using your house as collateral for a $15,000 loan. Essentially the same thing, but for what I'm doing, when I went through the line of credit through the bank, they said my payment would be $300 a month on this, on I think it was 3% interest on it. That's super low. So the reason why you don't want to use your credit card to pay faster into your mortgage, because you say, oh, I have a credit card that's over $50,000, why not put that towards my principal? The thing is, with your credit cards, obviously most credit cards are 12%, 13%, whatever. They're just higher interest that builds a lot faster, so it's not essentially good to use. I'd rather pay a 3% versus an 8% or whatever the case may be. So let's go ahead and erase this. Now we're explaining over here, right? So what I want to do is I want to pay $400 extra into the principal. So this is why this principal is $1,000. The interest is still the same because it's still at 3.75, so it's still $1,000. Escrow is still the same. Your tax and insurance is still $400. So this came out to $2,400. Now with this $15,000, what I would do is I put it straight into a savings. $15,000 into your savings. Just pull out this entire thing. And as soon as you pull this out, you start paying your $300 a month on it. Now you can play with this. You can make it $1,000 back to it. It just depends. You can use any numbers you want, but I'm gonna explain why. you could essentially keep it at $300 and $1,000, just depends. But this $15,000 for the next 5 months, because that's how much it generally comes out to for the next 5 months at $2,400. 5 months, you're paying your mortgage with this only. Don't use your actual income. Leave this alone because I'm going to explain what we're going to do with this in a minute. But just use this $15,000 to put, it'll last you about 5 months to put $2,400 that will pay this. Now, wait, you might be asking, well, why don't I just put the $15,000 to the $400,000 and call it a day? Well, you could do that. I mean, essentially, if that's what you want to do. But the reason why I wouldn't do that is because for the next 5 months, this is how I'm paying for my mortgage. I would pay, for the next 5 months, I pay $300. This is assuming that you have all your debt paid off and you have like very little debt. You're just paying $300 a month. So this becomes your new mortgage from, this is what you're getting paid monthly. So this just becomes your new mortgage because your actual mortgage is being paid through this, plus you're adding that $400 extra. And for the next 5 months, you're pocketing that $1,700 because your $300 was paid into the extra $2,000. So this is what you're pocketing for this, and whoo, that's a positive. And you can use this and just continue. So for the next 5 months, you get to save this. Now you can put that back in there and pay it off. I mean, it just depends what you want to do. I generally would use this for a savings. Even if you use all of this, you still significantly put a bigger principal down for this. So for this, you would have paid in that 1 year, let's just say if you had that $15,000 and you were able to do it again because you paid it off right, you would generally owe $388,000. Now, and this also builds a larger equity base. So building a larger equity base will help you get funded for more deals, like using your house to buy another house, or refinancing it and pulling out about $100,000 and whatever your house is worth. Because remember, this is essentially, your house depreciates at the value. So that's a different video. We'll talk about what we can do with that. And then this one over here, you're paying that generally at $600, and generally in that 1 year, you're paying $392,000, or you're paying the just only $7,200, and that's pretty much where I got my $392,000, because that's what the 600 times 12 is $7,200. So that's what you pay to your actual principal. Over here, it comes out to the extra $1,000. Obviously, $1,000 times 12 makes $12,000 to your actual principal, making it $388,000. Now, these are big differences. You can see why your house will be paid off faster. And if you're consistent at this, by the end of your interest, you'll only be paying, if you times this by your 3.75, generally if you, and this is how you you have to play around with it, because to 7 years, like this probably is not exactly 7 years. It might actually just be 12 years. I'm not 100% sure. You can play around and do with what you want. But generally, I'm still paying the same in my taxes is $12,000. Over here, I'm still paying $12,000 a year in taxes, but over here, I'm adding an extra $400 to it. So we're doing a bigger end it, and then the escrow is pretty crazy. You're putting a significant difference between your actual loan and the value of the home. So you're creating a larger equity in your home in a lot faster time frames. If you did this for 2 years and you're able to get your numbers right, I mean, you built a larger in that 2 years equity difference than you would if you just did it right here. Now, this is not considering the appreciation value of your home, because obviously all that is different, and that's not factored into this. This is just saying if it stayed at your loan of $400,000. So I hope you guys really enjoyed this video. If you were confused at all, definitely press the like button. If you would like more information about this, I would definitely do your own research, figure out, there's a bunch of stuff out there. This is absolutely not financial advice, so don't take it that. And if you want to actually know more, I would see a financial specialist or a consultant to get a better understanding of what this is. Just what was kind of explained to me, and this was what makes sense. You're paying it off in 12 years, 15 years, 16 years, 20 years, whatever the case may be, you're still not going to spend 30 years on it. But I hope you enjoyed the video. If you definitely enjoyed, We need more subscribers, so I need you to subscribe because I'm putting out more videos, and generally I'm about to start investing in homes, and I'm about to explain what I did and my incomes from those homes. So this is why if you buy your house, you can use your house as leverage for a difference to pull out a home equity line of credit, and you can generally do this. You know, the line of credit may be more because your house might be worth more, but generally you're gonna be paying that. So if you did this and you used my method or whatever method you come up with of how much you want to put towards your actual mortgage, you'll pay it off faster, build more equity. Now press that like, subscribe, share, notification button, and enjoy you guys the rest of the day. And you enjoyed this video, just give me that like button.